I'm sure you've seen some of the silly chatter in the trading chats and forums about, oh, you must be a market maker, so-and-so's a market maker. So who or what really are market makers? Technically, a market maker can be either an individual or a large entity like a bank or financial institution. It's usually specialized firms or departments within large financial institutions, and their job is literally just to make sure that the markets have liquidity and run smoothly. But what does that mean? If you've ever wanted to know what a market maker is, but can't get a straight answer out of the online groups or even Google searches, that was me. So I'm going to try to explain what a market maker is and isn't, so you can actually understand how they could be affecting your trades. So who are market makers? One of the biggest and most influential market making firms is Citadel, so I'm going to pick on them a little bit. They handle a significant amount of volume of U.S. trades, especially when it comes to equities, which is stocks, options, and interest rate swaps. Citadel was formed by Ken Griffin in 1990 and now manages over $60 billion in capital. They're involved in high-frequency trading and market making. They really can end up going hand in hand, and you'll see why. So in that way, Citadel, as the institution, is the market maker. But so are a lot of the employees, the actual people who are there working for Citadel day to day, who are in charge of overseeing the software systems that keep market quotes continuously updated for us. They have teams that maintain and fine-tune all of the algorithms that quote buy and sell prices. They monitor market conditions, and they're making sure that everything is running smoothly. Using all of the information that they can gather from all of the market data, market makers, as in the employees of Citadel, are going to need to make real-time decisions based on all of that data and the trends in order to manage Citadel's risk, while also being really careful to keep everything in regulatory compliance and moving smoothly. Really, a market maker could be anyone from a smaller trader like 𝘄𝗵𝗶𝗹𝗄 to the big names like Goldman Sachs or Citadel. But in any case, their main job is the same, and it's to make sure that there's enough liquidity in the markets to facilitate smooth trading. So what are they actually doing day to day? It's pretty hectic. They've got to keep tabs on news and economic indicators, earnings, and geopolitical events, which is a lot. So they'll end up having computers assist with the computers scanning news, and they're going to alert market makers whenever there is a particular keyword or anything else going on that needs attention. But those computers can also react to the markets in real time. These are one of the many kinds of algos in use in the markets that a lot of retail traders really don't understand. Computers running algorithmic programs overseen by market makers are also constantly quoting the buy or bid and sell or ask prices. They'll also execute their own trades as well as trades on behalf of their clients. Remember, Citadel is managing $60 billion. They'll have departments for research and analysis, technology maintenance to actually keep all these computers running, software programming to keep developing all of these algorithms and tools that they're using. They, of course, need a compliance department. And last but not least, some cute salespeople so that all of these technical people and nerds can focus where they work best. So how do market makers make money? They make a lot of it, and they certainly aren't keeping all of their eggs in one basket. The most significant source of income for a market maker is the difference between the bid and ask prices. For each trade, they earn the spread between these prices. So even though the spread is usually small, the high volume of trades can lead to some significant profits over time. Some market makers may charge commissions or fees for their services that they provide to some other firm. So especially if they're providing liquidity to other traders or institutions, they'll get a commission for that. Market makers can also take advantage of arbitrage opportunities by literally exploiting the price differences between different markets or trading platforms. So if they buy at a lower price on one platform and sell at a slightly higher price in another platform, they can lock in some risk-free profits there, just taking advantage of that spread. Market makers also hold their own inventory of securities, and when they manage this inventory effectively, they, of course, can profit from changes in price in these securities, just like the rest of us. So if they anticipate a price increase, they can hold on to that security and sell it later, or if it's looking like the future isn't that great, they can cut it and move their funds somewhere else. Some exchanges also offer rebates or incentives to market makers for providing liquidity to the market, and these payments can be an additional source of income. Of course, in addition to making the markets, a lot of these firms are going to be doing their own proprietary trading, using their own capital and their clients' capital to trade securities and just generate regular market profits. It's probably more fun to picture a market wizard controlling all the markets with godlike powers. So, if we need to have a character there, I guess we can hold on to that. But now you know kind of what's going on behind the scenes with the market makers. More answers to your trading questions coming up. And in the meantime, you know the drill. See you soon.